Ladies and gentlemen, good day and welcome to Poonawalla Fincorp Ltd Q4 FY22 earnings conference call hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ajit Kumar from Ambit Capital. Thank you, and over to you, sir.
Thank you, Farah. Hello, everyone. Welcome to 4Q FY22 earnings call of Poonawalla Fincorp Ltd. Today we have with us the entire senior leadership team led by Mr. Abhay Butada, Managing Director, Poonawalla Fincorp Ltd, Mr. Sanjay Miranka, Chief Financial Officer, Mr. Manish Jaiswal, MD and CEO of Poonawalla Housing Finance, Mr. Rajiv Kumaraswamy, MD and CEO of Magma HDI General Insurance, Mr. Mahendra Bagrodia, Head Collection, and Mr. Manish Chaudhary, President. We will start with the opening remarks from the management and then move to question and answer. Over to you, sir.
Yeah, thank you so much, Mr. Ajit. So, good afternoon, everyone. Welcome to the Poonawalla Fincorp Q4 FY22 earnings conference call. I will take this opportunity to wish and hope for a safe and happy period ahead for all of you. During this call, we will first summarize the business environment in which we are operating and then take you through the Poonawalla Fincorp's FY22 journey of consolidation phase involving the acquisition, the integration, the business transformation, tech, digital turnaround, along with the consolidation of people, processes, and products. As we look back at the outcome of the phase, we are very optimistic and confident about the company's prospects going ahead and the growth trajectory of the company would see in FY23 and beyond. But before I talk about the business, I must outline the current business environment in which we are operating in. On the macroeconomic front, the inherent economic strength and potential growth for India continues to remain robust. This is indicated by all-time GST collection number in the month of April, world's highest GDP growth projection for India during FY23 by IMF, and the sharp business expansion visible in April PMI numbers. The company, by virtue of its inherent strength and the in-place growth levels, is well placed to ride the rising curve of credit growth that lies ahead for the economy. Though the monetary tightening by RBI and threat of unexpected inflation may act a headwind to the growth trend of the economy and credit demand, however, we as a company are well prepared to manage the rise in the borrowing cost. The removal of accommodation by RBI is an expected event to control inflation, and this is factored into our business. The extent of borrowing cost reduction and deep repricing done by us last year hold us in a good state to ensure marginal decline to flat borrowing costs in FY23 as against Q4 FY22. The company would continue to diversify its funding sources and liquidity pools to optimize the borrowing cost. FY23 would see the full benefit of 100% term loan repricing done till FY22. The geopolitical risk have also risen driven by the Russia-Ukraine war. However, back at home, so far we have not seen any major setback to domestic business condition. We expect that the structural factors to drive the retail credit growth, the growing acceptance of credit, rising internet, smartphone penetration, consolidation of marketplace in favor of digital aggregators, untapped credit needs of retail and the MSME sector. So FY22 has ended on a very positive note for us with all the basic in place and momentum by our side. I will give you a quick update on key metrics, and later on our CFO Mr. Sanjay Miranka will cover the same in detail. So disbursements stood at 9494 crores, up 158% year on year. AUM stood at 16579 crore, up 17% year on year, 9% quarter on quarter. Average cost of borrowing reduced by 215 bps over Q1 FY22, while GS3 and NS3 stood at 2.7 and 1.1 as of March 22, down from 3.5 and 1.8 quarter on quarter respectively. The NIM stood at 8.9% for FY22, up from 8.2 FY21, while PAT stood at 375 crore. Our return on assets stood at 2.5 for FY22, and the capital adequacy, which is quite comfortable, as of now it is 49.5% on March 22. We continue to hold management overlay of 140 crore, which is 0.8% of our AUM. With this, we are at the cusp of moving from consolidation into the growth phase. With all growth levers in place, we are confident of our trajectory ahead in FY23, and we will continue with our excellence to deliver on our management vision 2025. We believe our digital-first tech-led strategy is a source of economic moat, which brings operational efficiency and will lead to sustained profitability. Being digital to the core, at the start of the year, we embark on an end-to-end digital transformation across sourcing, sales, underwriting, customer onboarding, collection, and customer servicing. Within a record time, we have implemented the state-of-the-art LOS, LMS, CRM platform, all newly launched new optimized website with a seamless integration to our backend system. We remain committed to it, and we will continue to invest in people and technology capability for building business transformation. A couple of developments that I want to highlight. Recently, in the board of directors of the company on May 12, 2022, have given an in-principle approval to raise funds for PHFL subsidiary and a dividend of 20% on the face value of the share, subject to the shareholders' approval. The housing subsidiary has almost doubled its AUM in last 2 years, crossed 5,000 crore of AUM in March 2022. The proposed capital raise would not exceed 1,000 crore and would be used for business expansion, presence enhancement, and fund the AUM growth. This growth capital infusion, we believe, will to grow CAGR of 25 to 30% and will be able to achieve 10,000 crore AUM in housing subsidiary by 2025. Thank you, everyone. And with this, I hand over to Manish Jaiswal, Managing Director and CEO, Poonawalla Housing, to take us through the housing subsidiary update.
Thank you very much, Abhay. So coming to Poonawalla Housing Finance Limited, over the last 4 years, the institution has emerged as a leading affordable housing finance company with a focus on low-income group and contiguous markets across semi-urban, peri-urban locations in 128 branches across 20 states. The company has a national presence, a granular retail portfolio with an average ticket size of 11 lakhs per customer, and the customer base expansion has been 4 times over the last 4 years and currently stands at around 46,000 customers. The company has recorded 29% CAGR growth over the last 4 years. The affordable housing finance franchise has been consistently built with a relentless focus on imparting our mission, dignity of living, to our customers by serving them directly through our mission of Go HL and Go Direct. The company's business model has undergone significant transformation over the last 4 years, and our on-book affordable home loans stands at 69%. The financial year ended March 22 has been momentous for the organization. As Abhay just mentioned, the company went beyond the mark of 5,000 crore to close the year at 5,060 crore with almost 27% AUM growth. The disbursements increased by 57% over the last year and stood at 1,970 crore, and the disbursements for the last quarter alone stood at 797 crores. 77% of our business has been sourced directly. The earning assets book, in fact, ran ahead of the AUM growth and stood at 46% increase over last year, and the ratio of earning assets to total assets has sharply risen from 73% to 84% of AUM in the current fiscal. Poonawalla Housing delivered its highest ever profit before tax of 101 crores against 14 crores last year, and the ROA of the company stands enhanced from 0.3% last year to this year at 1.8%. The PBT for the quarter enhanced from previous quarter of 28 crores to the last quarter of 36 crores. The company's business model of high margin, high growth, and most importantly, high quality has withstood 3 stress shocks of the pandemic and has shown resilience to bounce back with collection efficiency for the quarter at 98.9% against 97.6% for the previous quarter. The company recorded its lowest ever gross stage 3 assets at 0.96% at the end of FY22, and it carries a robust TCR at 37.44% for stage 3 assets, and it has overall provision at 1.7% of the loan book. Poonawalla Housing Finance has been assigned the eminent long-term CRISIL ratings at AA+, stable. The company's cost of borrowing saw a sharp reduction of 230 basis points from 9.1% at the beginning of the year to end the year at 6.8%. The company has no short-term borrowings and all ALM buckets are positively matched, and it carries a liquidity of 1,100 crores in form of sanction limits. During the year, the company has received a fresh sanction of 725 crores from National Housing Bank and the overall fresh sanction of 3,675 crores. Overall, in summation, the last year performance of the Poonawalla platform saw many numerous institutional milestones, both financial and non-financial, being met, and the company is poised to build further momentum from here with a sharp focus on quality vectors of growth. We are grateful to our investors, customers, employees, bankers, business partners, and most importantly, the regulators for placing their faith in the institution and supporting the mission of dignity of living to the affordable housing segment. I now hand over to Manish Chaudhary, the President of Poonawalla Fincorp, from here on. Thank you.
I'll quickly take you back to our strategy that we announced when the acquisition happened of Consolidate, Grow and Lead. Coming to the FY22 journey of Poonawalla Fincorp's consolidation phase, we have been able to successfully plant all the levers of growth during FY22 to achieve our goals set for FY23 and beyond. We could witness the momentum starting from Q4 itself. We achieved the highest ever monthly disbursements in month of March for our continued products of pre-owned cars and home loans. Our unsecured offerings, including digital BL, PL, and LTP, which were rolled out during Q2 of FY22, also scaled up during the year and recorded their highest monthly disbursement in March 22. We made an addition of digital consumption loan product to our 100% retail product portfolio in March through the partnership mode. The Housing Finance Company subsidiary, PHFL, which is a pan-India pure-play affordable housing finance entity, crossed the 5,000 crore AUM milestone during March. It also delivers its best disbursals, highest ever AUM, highest PBT, and the lowest ever GS3 during FY22. The company's focus on retail and small business segments, aided by the digital and technology-backed product offerings and backed by robust balance sheet, gives us an edge over others in tapping the structural credit growth factors. The positive developments like leaderboard entry in POC and LTP on monthly disbursement basis, further strengthening of the retail product offerings, and sustained scaling up of the affordable housing subsidiary makes us confident of achieving our 2025 vision of becoming the top 3 NBFCs in consumer and small business finance. The tech integration with partners via API sharing and CRM extension has led to a seamless flow of information. The straight-through processing enabled by business rule engine has led to a quick decisioning and consistency. Digital onboarding using digital KYC, the digital mandates, e-mandates, e-applications, e-contracts, and disbursements have enabled smooth onboarding and superior experience for all our customers. As a result, the end-to-end turnaround time has seen substantial reduction over the quarters and is now amongst the best in the industry. We also created an in-house contact service center to ensure we offer excellent customer service with focus on first-time right resolution. The quick loan turnaround combined with the end-to-end digital journey, digital engagement with customers, and focus on overall experience makes us a truly customer-oriented organization focused on bringing customer delight. Our fintech architecture and digital capabilities make us a preferred partner for other fintech players in the ecosystem and enables us to leverage the strategic partnership to accelerate customer acquisition and to offer digital-first products. We have also made the onboarding journey of our channel partners more seamless via digital onboarding with less than a day of turnaround. We also continue to invest in our data mining capabilities to leverage data analytics across sales, underwriting, and collections. As India continues to grow in a digital way, we at Poonawalla are committed to remain digital first and a tech-led organization to the core. In line with this aim, we'll continue to make deep investments in technology to drive economies of scale, enhance productivity, and build a profitable digital first tech-led franchise. We have further strengthened our distribution pillars of digital direct and partnerships, DDP as we call it. Our distribution strategy focuses on DDP, and we would continue to seek these ROA accretive opportunities to tie up with the like-minded, digitally focused market players having scale and the right risk management practices. The disbursement contribution of the DDP channels stood at a healthy 17.5% in Q4. The API stack integration with partners allow a seamless sharing of data and gives us an edge in partnering with fintechs as well as other digital players in the marketplace. The contribution of partnerships in the pre-owned car book disbursement has more than doubled in Q4 of FY22 over Q3 of FY22. The pre-owned car marketplace is undergoing consolidation in favor of digital aggregators, and we expect to see further disbursement traction as the trend intensifies. Also, with the rise in customer acquisition, we expect cross-sell to act as an ROI kicker for us. Our disbursement from cross-sell has increased 28% quarter-on-quarter during Q4 FY22. There's also been an exponential rise in leads generated from digital marketing with 10x growth in Q4 alone. We expect the funnel optimization to make it a significant contributor in the coming quarters. Risk management is the most critical piece for our business. Post-acquisition, we tightened the underwriting standards, front-ended the write-offs, followed the most stringent write-off policy, and placed a conservative portfolio guardrails using analytics for policy optimization, and also monitored early warning signals for our portfolio. As a result, our asset quality significantly improved, and we have been able to bring the net stage 3 at 1.1% as on March 22, which is among the best in the end space. Our portfolio remains well within the set guardrails. The portfolio we have onboarded post the acquisition has been performing much better than the portfolio onboarded prior in terms of the early indicators of bounce rate, the 0+ delinquencies or the 30+ delinquencies. We also witnessed substantial rise in collection efficiency with the March figure at 108.4%. With fall in cash collection accounts, our need for branch infra has also come down. Our branches stood at 242 as of 31st March 22, down from 297 in March 21. Gujarat, Karnataka, Maharashtra and Tamil Nadu are the areas where we opened branches during the year. The consolidated AUM remains well distributed geographically. On the people and operations consolidation front, this has been another.
I'm sorry to interrupt, sir. I'm unable to hear you right now. Management team, we are unable to hear you clearly. Ladies and gentlemen, we are going to disconnect the management line and reconnect as there's no.
Over to Sanjay, our CFO, to take us through the financial performance.
Thanks, Manish. Good afternoon, everyone. I am pleased to share the financial performance update for Poonawalla Fincorp Ltd for the financial year FY22 and Q4. Consolidated AUM grew by 16.5% YOY and 8.9% quarter-on-quarter and stood at rupees 16,579 crore as on 31st March 22. AUM of focused products grew at a faster rate of 64% YOY and 17.3% quarter-on-quarter, which is highly encouraging. The discontinued book now stands at 17.9% of our consolidated AUM, and we expect it to run down over the next 18 to 24 months. During the month of March 22, our housing finance subsidiary crossed 5,000 crore AUM mark. PHFL AUM stood at 5,060 crore as on 31st March 22, growing by 27.2% YOY and 10.6% quarter-on-quarter. We saw good traction in all our active product lines and witnessed the highest ever monthly disbursements across all our products. Total disbursement for Q4 stood at rupees 3,336 crore, showing a growth of 80.8% quarter-on-quarter. FY22 disbursements stood at 9,494 crore and grew at a robust 158% YOY. Q4 NIM improved to 9.5% vis-a-vis 8.8% for Q3 FY22, an increase of 77 basis points, whereas the FY22 NIM stood at 8.9%, an increase of 65 basis points YOY. The consolidated profit after tax stood at rupees 375 crore for FY22 as compared to a loss of 559 crore in FY21. The ROA stood at 2.5% for the full year. The Q4 ROA was at 3.1% with quarter-on-quarter rise in each quarter during FY22. The board of directors have also recommended a dividend of 20% in the very first year of our operation post-acquisition. The normalized cost of borrowing for FY22 after adjusting for one-off prepayment charges in Q3 comes to 8.5%. The average cost of borrowing for Q4 was 7.4%, a sharp reduction of 63 basis points over the normalized average cost of borrowing for Q3 FY22. During Q1 FY22, we framed the management vision 2025, including a 250 basis point reduction in cost of borrowing. I'm happy to share that we have already achieved 215 basis point reduction in average borrowing cost between Q1 and Q4. During the Q3 call, we had guided for 50 basis point incremental reduction in Q4 and above what was achieved till Q3 FY22, and we have surpassed that number, with the actual reduction coming at 63 basis points. Besides a two-notch rating upgrade by CARE in Q2 FY22 to AA+ stable, in Q4, CRISIL also assigned long-term rating of AA+ stable to both PFL and PHFL. We understand that the recent interest rate rise is a key issue for the entire credit industry. After factoring in the current rate hike as well as anticipated rate hikes by RBI in FY23, we expect our liability book repricing to be well spread over the year instead of a sharp rise in a single quarter. This is factored into our funding plan. Factoring in all the scenarios on a conservative basis, we are confident of keeping our average cost of borrowing for FY23 below Q4 average cost of borrowing and well below the average cost of borrowing for FY22. On the asset side, floating rate assets would be repriced higher in conjunction with liabilities, while maturing assets would benefit from redeployment at better rates. Talking about our liquidity surplus and ALM, we had a comfortable liquidity of rupees 3,890 crore through on and off balance sheet liquid assets. Both PFL standalone and PHFL carry a well-matched surplus ALM across all buckets as on 31st March 22. Our funding pipeline remains robust with competitive rates as demonstrated. On OPEX front, cost-to-income ratio came down by 110 basis points during Q4. Being a young and digital-first tech-led entity, the company will continue to invest in technology, people, and customer service initiatives. Those stage 3 book declined sharply by 103 basis points YOY and 84 basis points quarter on quarter to 2.7%. The net stage 3 book as on 31st March 22 stood at 1.1%, well on path to realize the 2025 vision of less than 1% of net stage 3. Our housing subsidiary recorded the lowest ever gross stage 3 at 0.96% as on 31st March 22, declining by 63 basis points YOY. Our restructured portfolio reduced further to 4.7% of AUM as on March 22 compared to 5.7% in December 21 and 5.9% as on September 21, aided by strong recoveries. Collection efficiency continued to surpass pre-COVID levels and was at 108.4% for March 22. As on March 22, our provision coverage on stage 3 book stood at 58.9%, one of the highest in the industry. As on March 22, we are carrying about 140 crore of specific COVID provisions. The ECL model provisions this year include the impact of COVID into PD LGD. Hence, the ECL model provision across stages has increased over December 21. PFL's capital adequacy was 49.5% as on 31st March 22, providing significant enabler for future business growth. Thank you. Over to you, Ajit, to moderate the Q&A session.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2.
Ajit, over to you.
Sir, I hope you can hear me. This is the operator.
Ajit, we can't hear you.
Ladies and gentlemen, if you wish to ask a question, you may enter star and 1 on your touchtone telephone. This is a message for the management team. I hope you can hear me, the operator of the call. Ladies and gentlemen, we believe the management is not able to hear us. I'm going to disconnect and call them back so that we can refresh their connection. Please do not disconnect your lines. We'll reconnect the management team. Ladies and gentlemen, we request you to please remain connected. We are trying to reach the management and reconnect them to the call. Please do not disconnect. We appreciate your patience. Thank you. Ladies and gentlemen, thank you for your patience. We have the management line now connected. We would like to request participants, if you wish to ask a question, you may enter star and 1 on your touchtone telephone. We'll take the first question from the line of Nikhil Rungta from Nippon India Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for this opportunity and congratulations on a great set of numbers. Sir, first is starting
Sorry,
on this.
Mr. Rungta, if you are on a hands-free mode, please switch it to handset and speak. We can't hear you clearly.
Is my voice audible now?
Yes, better, sir. Thank you.
The first question on this housing stake sale. So basically, you are planning for 1,000 crores of capital raising for a valuation like 15% odd. So internally, you would have done some calculation and type of valuation actually you are looking for, or should we assume this same 6,500 to 7,000 odd crores of value which comes through back calculation?
So let me not get into valuation we will focus on business and performance. We let markets do their bit of assessment, but there are great benchmarks available. So all of you would probably have your own conjecture. We'll wait for the formal process of valuation discovery to happen, and that should kind of really be telling us about the quantum of dilution to be done. But very clearly, we need growth capital of 1,000 odd crores. So that's our ask and that's our need. And being CRISIL AA+ rated and the kind of quality of performance and numbers, I think it's one of the upper quartile performances which will kind of really show in terms of our expectations.
Okay. And second, coming on the OPEX side, we have indicated around 30 basis point of impact because of this ESOPs. So should we take this 30 basis point itself for next few quarters as well, or you think this could change materially?
Yeah. So Nikhil, I think as an organization, we have adopted a very progressive approach of giving ESOPs and making people as partner in the growth journey. We have set aside already 2% of the capital for ESOPs, and more can be added to that. So as far as your specific question is concerned, yes, the charge will increase in FY23, but as you know, this is basically a notional charge to P&L, and will get reflected multifold into the performance of the company.
Okay. And OpEx other than ESOP is 5.2% because we are investing a lot into technology and people. So what type of sustainable OpEx should we look for the company, say, over next 2 to 3 years?
Yeah. So we have been investing in technology, people, and customer service initiatives, and we'll continue to do that through FY23. However, as we keep getting the full leverage of the capability which we have built, you'll see the cost income ratio coming down. So for a few quarters in FY23 or broadly on FY23, the OpEx may remain around these levels or may move up. However, this is the investment into the long-term growth for the organization, and post FY23 you'll see sustainable reduction in cost income ratio.
Okay. And sir, last question from my side on the provision. So we had made a big chunk of provision earlier. So how much of that is used, and when will we see standard asset provisioning coming in our numbers?
Yeah. So we have been carrying COVID provisions of 140 crore as on 31st March 22. Basis the performance of the portfolio and the environment, one could have written back a part of this provision, but on prudent basis we thought that let's carry it into future year, and every quarter we are going to have an assessment, and accordingly we will go for the amount which can be released out of this. Yeah, okay. And overall provision is very healthy at 58.9% as far as the stage 3 PCR is concerned.
Right. Perfect, sir. That's all from my side. Best wishes for the future. Thank you.
Thank you.
Thank you. We'll take our next question from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead. Mr. Vivek Ramakrishnan, could you please go ahead with your question?
Hello, can you hear me?
Yes, sir.
Yeah.
Okay. This refers to slide 21, where you have given the product suite that you have, which is a very well spread out product suite. Could you tell us which product will dominate the mix, and whether there's a commonality of the customer segment that will allow you to keep your OpEx low and yet grow? That's my only question. Thanks.
Sure. So the way we are looking at the product suite is we have a mix of products which are both medium term as well as short term. I think what we are trying to achieve here is both the profitability as well as the AUM growth. The long term, medium term products will actually help us grow the AUM and help get the OpEx under control. While the short term products, as you see here, which are supply chain finance, which are merchant cash advance, the EMI cards and the credit card, these will help us actually add to our bottom line, may not really add to the AUM part. So I think it's a conscious. It helps us manage two things. One is the profitability. Second, it also helps us leverage the liability side of it that we have. So that's the way we are looking at it from a product strategy perspective.
Okay, sir. Then could you just break it up into secured versus unsecured in terms of how you would look at it?
Sure. So when we look at any of these, if you look at on the existing products only, that we have today, the pre-owned cars, the affordable home loans, the LAP, medical equipment, auto lease, these all remain as secured products. Also, if you look at it from a digital SME LAP perspective, that is again another secured loan product. The way we are building up on the unsecured loan products, which are the business loan, personal loan, and the consumption loans and professional loans that we are seeing, these are actually acting as feeder for our other secured loan products. The medical equipment ties in with our loan to professional segment that we do. Similarly, we want to be a substantial player when we look at the MSME side of it, and that is where the merchant cash advance and supply chain finance come into play. While typically you look at supply chain finance as an unsecured product, technically we'll look at it as a secured product because we will have the corporates and the anchors, involved there. Again, the machinery loan is something which will continue to be a secured product. The rest of the products, which are unsecured in nature, what typically do not bring in too much of risk to the book because these are all short-term products that we are entering into. On a steady state, what we want is a good balance of secured and unsecured. Today, if you look at it, the book that we'll have about 19% of the product, which is on the AUM mix, if you look at it, which is unsecured. At a steady state, as the book drawdowns, which is the old book, we will actually be hitting a number of around about 30 to 35% by the end of this FY23.
Okay, excellent, sir. So secured products, unsecured products would be used as a lead for the secured products, and they would be short-term in nature, is what you're saying, right, sir?
Yeah, it will be a mix of short-term as well as long-term, but short-term just to manage the profitability.
Okay, excellent. Good luck. Thank you very much.
Thank you so much. Yeah.
Thank you. We'll take our next question from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Thank you very much, management team. It was indeed a very fantastic result. You have mentioned supply chain advance and merchant cash advance. What will be modus operandi and how much business we are thinking for this work?
Sure. Thank you very much for the question. Let me take it in two pieces. When we look at supply chain finance and the merchant cash advance, the first thing is we don't want to do this business through any intermediaries. These are all going to be the direct products for us, right? First is the way the origination is being looked at. Second, the way we look at it is, what is the kind of customer segment that we want to target here? On the supply chain finance side of it, we would want to target big corporates and their downstream or upstream cycle that we want to manage, right? On the merchant cash advance side of it, as we see the digital economy is actually booming, we want to look at merchants who accept card payments, who accept UPI payments and other modes of digital payments. So this merchant cash advance is going to be typically looking at segments which have the digital acceptance of all the payments in the ecosystem. These upcoming products that we said, both of supply chain and merchant cash advance, as we said, are short-term products, and hence they will actually help us also widen our customer base, which is very critical as we grow, because we want to be a big cross-sell franchise as well.
Okay. So what will be rate of interest in range, can you tell?
So we will be quite competitive in this. We look at supply chain finance at any range between 12 to 13%. And when we look at merchant cash advances, the APRs could be higher as these are short-term products.
Right. And second question, sir, direct digital partnership model you have mentioned. Whom you will do partnership? Can you tell something?
Sure. So as we speak, we've been kind of focusing on this as one lever for our origination capabilities. On the direct side of it, we have two splits that we have. One is our direct sales force, which goes and actually acquires this customer. However, the entire origination is now moving to a digital mode. So we have actually in-house developed contact center, which helps us originate the leads through calling up the customers or through the inbound that we get, right? So that is going to be one mode of direct. As far as digital is concerned, as you know, we have our website where we have an end-to-end digital journey for all the unsecured products that we have. So we use that and leverage that for our digital direct originations. Apart from that, on the partnership side of it, as we have outlined, various products, it will be, horses for courses kind of a strategy. You look at POC, for example, where we have the digital aggregators who come in as partners. We're also exploring co-lending opportunities across various products. That will also be a form of partnership. And as we know, on the LTP side of it, we have a pan-India tie-up, which is for professionals across chartered accountants, company secretaries, and medical professionals. We continue to build on such partnerships, which actually help us reduce our cost of acquisition as well.
Thank you, Abhayji, and your whole team. You had given a very good, fantastic result. Thank you very much.
Thank you.
Thank you. We'll take a next question from the line of Harshvardhan Agarwal from IDFC Asset Management. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, I have two queries. One is the disbursement number that we have reported around 3,300 crores. Just wanted to understand, does that has an element of any inorganic portfolio that we have acquired? That is one, and maybe post that I'll ask another question.
Yeah. So yes, that number has got both organic and inorganic book. However, if you look at our core focus has been building the organic book, and that's where quarter on quarter there has been a significant increase in the disbursement of organic book. So the organic book, okay, which was about 1,500 crore in Q3, has been 1,850 crore approximate, okay, in Q4. And this is since we have been having surplus liquidity, and there have been opportunities, okay, value accretive opportunities available, and we have gone ahead and acquired the portfolio, okay, in Q4. However, as I said, the greater focus is going to be on the organic pool, and I think now that we have launched majority of our new products in the market, across the product, as we articulated it earlier, there have been a significant uptick in the disbursement, and we expect that to okay keep pace as we get into future.
Just to add on this, pre-owned car we have done highest ever disbursement in the month of March. So organic disbursement for POC was 165 crore. Loan to professional highest ever disbursement, we have crossed 100 crore disbursement in the month of March. And SME LAP also we have crossed 100 crore of disbursement. In affordable housing company also we have crossed 225 crore of highest ever disbursement. In most of the products we have done highest ever disbursement in the month of March. And these are all organic figures, and in few of the products, as we mentioned in the presentation also, we already taken a leadership position in monthly disbursement figures.
Right, sure. Thanks, sir. Sir, one last thing that I want to understand was on the asset quality part. What I remember is when that RBI circular had come in for reporting the GNPA norms, we had reported around 550 crores of NPA, which is probably sitting in stage 2. So just wanted to know like how that number has trended in the fourth quarter.
Yeah, so the number has come down. So against 552 crore, it has been 506 crore before.
Okay. And this reduction of around 45 crores which has happened, is it largely through recoveries or like there was an element of write-off there?
So it has been primarily coming from recoveries.
Sure. Thanks a lot, sir.
Thank you. We'll take a next question from the line of Pankaj Agarwal from Ambit Capital. Please go ahead.
Yeah, hi.
Ladies and gentlemen, it looks like Mr. Pankaj Agarwal's line is disconnected. Anyone who wishes to ask a question may enter star and 1 on your touchtone telephone. We'll take a next question from the line of Sonal from Nirmal Bang. Please go ahead.
Yeah, thanks for the opportunity. So just wanted to understand on this digital tie-ups that we have. So, I mean, there has been a bit of negative news flows, around FLDG and all. So what kind of partnerships are we entering? Is it like a co-lending arrangement, or are those aggregators working more like, like DSAs to us? If you could give some color on that part.
Yeah, thanks. Thanks for the question. Just to tell you a flavor of it, as you said, all the partnerships that we are doing, the partnerships will go and, the ones that we enter into would need to have two things. One is the scalability, and second is the risk management practices that they have. And hence, FLDG is something that we are not really banking on saying, we would want the FLDGs only, right? Well, RBI has been looking at it in a very different way. We are cognizant of that, and that is how we continue to look at it. We have enough of our data analytics in place when we are getting into these partnerships. So the entire policy, the underwriting rules, and the risk management practices are the ones which are adopted as per our understanding of the product risk. We use we leverage on the distribution capabilities of the partners that we work with, right? So basically what we are trying to do here is leverage their distribution capabilities. However, from a risk management perspective, we want to keep ourselves insulated, and that is what we keep it to us. We really follow the underwriting practices that we want to do in any partnership in the true sense of it, rather than just looking at it as one mode of just increasing through the funnel approach.
Okay, it's just to get some more clarity, sir. So whether this would be more like DSAs or co-lending partners?
So we do a mix of both. So wherever we have the NBFC available for the partner, we would prefer a co-lending arrangement. In absence of that, we look at it as their origination with the risk management being done by us.
Understood. Understood. That's it from my side, sir.
Sure. Thank you.
Yeah, I would just like to just update the organic and inorganic disbursement numbers. So organic disbursement was 2,200 crore approximate in Q4 as compared to 1,543 crore in Q3. This is a growth of 40% quarter on quarter. And yeah, inorganic was about 1,150 crore. Thank you.
Thank you. We'll take our next question from the line of Pankaj Agarwal from Ambit Capital. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir.
Yeah, Pankaj.
Can you throw some light on competitive intensity in the housing finance segment? The reason I'm asking this question is that, a lot of large banks are entering into affordable segment, and we are seeing some mid-sized banks also expanding into the segment, apart from all the HFCs. So what kind of competitive intensity you have seen, in the recent times?
So my views here would be as follows, that on the contrary, the entire space has actually gone through a very deep rationalization. I would say that the housing industry landscape is of around 12.3 lakh crores, out of which the largest player will merge with the bank. So to that extent, the size of the industry itself has gotten halved. And of the top 5 players, we are quite aware about where are they in their journey so far. So there are large vacuous places. And if you really look at the affordable housing sector, which I would say is of around 18 odd companies, above 15,000 crore around there's only one company. 10 to 15,000 crore there are about a couple of companies. Around 5,000 crore there are 3 companies. And the geo intensity of most of the players are that they have 40 to 60% market share in 3-4 states. At a national scale presence level, there are far and few companies. So I feel that while around the metros and peri-urbans, there could be a little bit of deepening of intensity, but as we move towards the hinterland, we move towards peri-urban markets, I think there's tremendous opportunity given the GDP to debt ratio in our country, which is barely 9%. So to that extent, at least from next 5 to 10 years standpoint, we do believe there's significant play. As more players emerge, they would be largely geo-focused in far and few states. At a national scale level presence, I think there are very deep sciences which need to be understood before we really go and scale up. We've been doing it for 5 years, so I think we can speak from experience.
And given the competitive intensity and the growth potential, what kind of ROA and ROE you can expect on a sustainable basis? I know right now you're expanding, so that's a number, I would not look for, but let's say 3 years, 4 years down the line.
See, we anyway are at 1.8% for the year. We exited last quarter for the housing finance at 2.4. We believe that this is a year where we will kind of hold on to our OPEX to AUM for last year. We won't increase, but at steady state level, we look at a 3% ROA and sub 3% OPEX number in about 3 years time. We are at 3.4% OPEX to AUM in housing. So my sense is that this year, given our expansion plan of going to 42 branches, we'll be at 3.8%. But after this year, I think we will be seeing reduction of 30 to 40 basis points year after year.
Okay. And finally, if I look at RBI data, the housing loans are hardly growing at 7-8%. If I look at over the last year, the YY growth has fallen from roughly 13-14% to roughly 7-8%. On other hand, when I talk to lenders, including you, there is a lot of, positivity around the growth side, right? So what is the missing point, right? Because RBI data is showing a different number versus what lenders and developers are saying.
I would like to focus on talking about our space, about if the overall affordable housing, overall industry is of 12 lakh crore, the affordable housing segment is around 70,000 odd crore. This segment is growing at around 12 to 14%. This segment is poised for growth as per ICRA reports at 18 to 20%. We have been growing at 29% CAGR for last 4 years, and we believe that on the Poonawalla platform, we should be able to maintain our numbers from next 4 to 5 years standpoint. Therefore, our vision to double our AUM in less than 3 years is something which we believe is achievable, and it has been demonstrated over the last 16 quarters of performance.
Okay, fair enough. Thank you. Thank you very much.
Thank you. We'll take a next question from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
So this is a follow-up to the previous question on affordable housing. What are the customer segments that you're concentrating in terms of salaried versus non-salaried? What is the typical yield to maturity that you see? Are they first banking kind of customers with a lot of cash kind of transaction because you're on the NBFC side focusing a lot on digital, or would they be more NACH and bankable customers? So if you could give us a little more flavor on your HFC, that would be nice.
So 60% of our customers are self-employed. We will be moving towards 50% self-employed and 50% salaried. Our customers are typically low-income group customers, where the average household income of these customers could be from 30,000 rupees per month to 60,000 rupees per month. These customers typically are comfortable paying installment of 10 to 15,000 rupees per month. All our customers are NASH. 100% customers we onboard now are on NASH, and they are digital remittances. Coming to your question on digital, we have gone live on 2 important platforms, LSQ and FinOne, in the month of April. Our endeavor is to now host rule engines, BREs, and configure mass acquisition channels, and therefore the play of digital partnership and collaborations and housing is something which is underway, which will further add to our OpEx and efficiencies.
Okay, thank you. That was useful.
Thank you. We'll take a next question from the line of Sagar Jetwani from Phillip Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, how you are leveraging technology towards making underwriting process more stringent, and any comments on that? And also at the same time, you aim to grow fast. So what would be the underwriting policy specifically towards the unsecured loans? How would you maintain 700 plus CIBIL mix within the unsecured loans? So any comments on that? How would you maintain it stringent at the same time growing fast?
Sure. Thanks for the question. The way we look at it, technology is being leveraged across the functions. Underwriting happens to be the most important function, as the entire risk management starts from there for us. The way we've been looking at leveraging technology for underwriting is, number one, we have the best-in-class origination system which has a BRE into it. We've also onboarded the best-in-class BRE from outside. We use the Experian Power Curve for our BRE purpose. Apart from that, when we look at managing the risk, I think what is more important is to manage the entire ecosystem and leverage the information available in the ecosystem. So we are well connected through our API infrastructure across various sources of information which can actually kind of make the underwriting much richer. We also work very closely on the bureau data to figure out, what are the kind of customers that we are onboarding month on month. Just to give you a flavor of unsecured underwriting, 90% of the customers that we are onboard are more than 700 plus credit scores, which ensures that we are not actually going into the first time credit. We are actually going to credit tested customers. There's a huge opportunity which lies there itself from an NBFC segment perspective. Also looking at it from a risk management perspective from other sources, we are looking at making the fraud risk minimized when we are doing any such underwriting. We go to the source of the information directly to be taken out, so that we really don't have any fraud or manipulation which is possible in any of the documents. While we look at serving the MSMEs, we actually focus on the formal segment of it, which is already working on GST. And hence the GST implementation ensures that we are actually taking care of all the risk. It's more prudent underwriting rather than just a paper-based underwriting that we follow. With those things in mind, I think we are well positioned to ensure that the risk is not actually going up in our portfolio. Apart from that, we also look at it from an early warning signal perspective. And as I outlined in my opening speech as well, on the early warning indicators, we are at least 2x better than what we were originating earlier. I think that gives us a flavor of what we are doing right now.
Just to add on this, we are doing write-off at 90 plus for all the unsecured products. There are very few NBFC those who follow such stringent write-off policy. Thank you.
Yeah, sir, one more sub-question to this. How does early warning signs work? Can you please throw some light on that?
Sure. So early warning signs work on 2-3 different things. One is what you're looking at your on-book performance of saying, how the customer is on your loan that you have given. The second, you typically look at it from an off-book perspective. In case he has taken a loan from any other financer, then you actually do a validation check against saying, how the performance is on others' book. And if there are any triggers there, then it's a cause of worry for us, and we kind of put it separately and look at it and monitor it on an ongoing basis. The third, which we are looking at, is typically on the basis of the macroeconomic conditions which exist in the market, and we continuously evaluate it against that. So we do a mix of all these three to ensure that the early warning indicators keep the system healthy, and we have the hygiene in place when we are underwriting for the new cases.
Yeah. Thanks for the brief answer, sir, and all the best.
Thank you so much.
Thank you. We'll take our next question from the line of Sandeep Agarwal from Naredi Investments. Please go ahead.
Thank you. So my question is, what percentage is disbursed digital in Q4, and what is our target for the financial year 23?
Sure. So I'll break it up into 2 parts. One is, when you're looking at products which are end-to-end digital, our entire personal loan business, our entire loan to professional business is a digital business end-to-end. When we look at our business loan business, we have entire end-to-end process available, and hence it is depending on the way customer approaches us, we will actually give him a service accordingly. Today, almost 70% of the business that we do on the unsecured side is an end-to-end digital business. We have now moved on the pre-owned cars also on a digital journey. The entire partnership business that we're talking of will happen digitally and continues to happen right now as well. In terms of our LAP product, since there's a collateral involved, you really cannot have an end-to-end digital. But yes, from an origination and an onboarding perspective, we have it completely end-to-end. The endeavor is to move to the new product segments that you would have seen, which we are looking at MCA supply chain. These are products which are apt for a digital ecosystem play, and that is where we want to focus our energies on.
Okay. So my next question is, what is our average yield, sir, on the gross premium and for housing finance?
So if your question is what is the disbursal yield on housing finance?
Average yield, yes, sir. What is our yield?
Around 13%.
13% for housing finance.
Yeah, I mean, on the book, we have 70% home loan, 30% affordable LAP. The average of the two is 13%.
Okay. Thank you, sir.
Yeah.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference back to the management for closing comments. Over to you, sir.
Yeah. So, thank you so much, everyone. And I'm very happy to share these numbers with you. Poonawalla Fincorp records consolidated PAT of 375 crore in the first year of post our acquisition. And our AUM is up 17%, net NPA down increases to 8.9. Now we are focusing on the technology. Now we are focusing on the building risk culture. Now we are focusing on our housing subsidiary, wherein there is a huge opportunities there in affordable housing. Most of the products we are focusing on digital onboarding, digital collection, digital disbursement. Entire process is end-to-end digital for all the unsecured. So overall, I'm happy to share that now we have moved to the real growth journey, and here on you will see we are excited to enter this new financial year with momentum by our side, and the consolidation was there for us for FY22. Now we made a considerable progress in line with our consolidated grow and the lead strategy. We are well poised to grow as the execution excellence of consolidation phase propels us now into the growth of orbit. As we grow, the focus will continue to be on building a sustainable business on pillars of technology, digital-first approach, customer centricity, risk management, and the alternate distribution channel of digital direct and partnership. Thank you so much, everyone, for attending this conference call of Poonawalla Fincorp Ltd.
Thank you, members of the management. Ladies and gentlemen, on behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.